It turns out the only thing harder than designing the world's most advanced AI chips is actually building them fast enough to keep your customers from panicking. Welcome to Earnings Unscripted. It's July 16th, 2026, and we're looking at Taiwan Semiconductor, ticker TSM, and their second quarter results.
The structural demand they're seeing is just staggering. I mean, they pulled in roughly $40 billion in revenue this quarter. That's up 36% from a year ago. The high-performance computing segment alone jumped 20% just since last quarter. And management's openly admitting their packaging capacity is so severely constrained it's actually limiting their clients' growth.
Before we go any further, a quick reminder that Miro and I are just thinking out loud here. So this isn't financial advice. Please don't rewrite your entire portfolio based on our podcast. But bottlenecking the biggest tech companies in the world is quite the flex. I'm guessing the pricing power is there.
Oh, definitely. Gross margin expanded to 67.7%. And if you look at the bottom line, net income absolutely skyrocketed, up over 77% year over year.
Right, which sounds like an operational miracle. Except I watched the tape today and the market, they didn't buy it at all. The stock gapped down hard at the open and just couldn't hold momentum, drifting lower through the regular session to close in the red. Wall Street completely shrugged off that massive profit explosion.
Yeah, because a big chunk of that net income wasn't actually from making silicon. They quietly booked a massive non-operating gain by dumping shares of a legacy semiconductor investment, so that bottom line number is highly distorted. And underneath that artificially sweet quarter, they're warning about some pretty brutal margin dilution creeping in from their new operations.
Okay, that dilution is exactly what I need to understand because they also just committed an incredible amount of fresh capital to the Arizona expansion. How does management plan to defend those peak margins when they're suddenly subsidizing a massive overseas manufacturing footprint?
Short answer, they aren't going to defend those peak margins. Or actually not perfectly. Management literally gave us the puts and takes, warning that their 2-nanometer ramp is going to dilute gross margin by 3 to 4 percentage points in the second half of the year. Add the overseas fabs on top of that, which drag another 2 to 3% in the early stages, and you realize we've probably already seen the profitability ceiling.
So you're saying the moment they finally introduce the absolute bleeding edge tech, their reward is an immediate margin hit. That feels incredibly punishing. Why on earth did they just announce an extra $100 billion investment in Arizona if it's actively dragging down the core business?
Client pressure, mostly. Moving advanced nodes out of Taiwan isn't cheap, but the U.S. giants demand it. That pushes their overall Arizona commitment into entirely uncharted territory. But the really wild part isn't just the geography, it's the raw pace of spending globally to meet this broader AI load. They had to significantly raise their capital budget, guiding somewhere between $60 and $64 billion for the year.
Wait, that's just for 1 year? That's almost matching the GDP of a small country just to keep the servers humming. Doesn't that terrify you as an analyst? Because it sounds like they're just blindly trusting these massive forecasts from the hyperscalers. If the cloud guy is overordered, TSM is left holding a very expensive bag.
Well, that's exactly why they don't blindly trust the forecasts. The CEO, C.C. Wei, had this incredibly blunt moment on the call discussing what he called customer truth. He said, "I believe every customer tell me the truth. Everyone. You put all the truths together, it's not the truth."
Okay, that's just a brilliant, polite way of calling his clients liars. So how do they actually model real demand then? Do they just take the orders and manually shave a percentage off the top?
No, it's way more physical than that. Wei essentially admitted they act like real estate inspectors. They're checking AI data center construction progress, looking at building locations and power hookups, just to verify that the physical environment can actually support the chips being ordered.
Oh, wow. I assumed that kind of due diligence was mostly spreadsheet work, but they're out there auditing the concrete.
They have to. They're trying to prevent their high-end silicon from rotting in a warehouse's dead inventory, especially since their own inventory turnover just climbed from 80 to 87 days sequentially.
That makes sense. Although, earlier you brought up the accounting distortion that padded this quarter's net income. How much exactly did they make off unloading that legacy stock?
Right. They booked a massive disposal gain on Vanguard International Semiconductor shares. Roughly 63 billion new Taiwan dollars dropped right to the bottom line.
Right, which translates to over $2 billion US dollars. So that one stealthy stock sale heavily masks the true cash intensity of this whole capital ramp. If you pull that gain out of the numbers, you realize free cash flow actually shrank quite a bit.
Yeah, down about 17% quarter over quarter. It's a textbook capital spending wave. They're liquidating non-core assets to feed the AI beast, expanding footprints across 2 continents, and fighting off capacity constraints just to stay ahead of the roadmap.
But what happens when that new capacity finally comes online, right into a market where their clients might already be choking on their own power limits?
Well, that's exactly the multi-billion-dollar question. If power constraints suddenly stall these data center buildouts, you could absolutely see a capacity glut. But management seems wildly confident that demand outstrips those physical limits for now. In fact, they upgraded their full-year revenue outlook, now projecting growth slightly above 40%.
Wait, a guide that high for the whole year? I mean, that's a massive upgrade. Does the third quarter match that pace?
It does. They're targeting actually roughly $45.2 billion at the midpoint, but the trade-off is that they see profitability compressing just a bit, taking a step down from those peak gross margins as they bring newer tech online.
Which makes sense given that overseas deployment drag we talked about. But if you're booking those kinds of revenue surges, the street forgives a little margin squeeze. I'm curious though, with costs piling up, aren't they worried clients might finally shop around?
The CEO got asked almost that exact question, and he brushed it off completely. C.C. Wei literally said, choosing a technology, ramping it up, is not buying milk from 7-Eleven. You don't like it, you go to another store. No.
That's such a vivid picture, casually comparing semiconductor supply chains to grabbing a carton of milk. But it's true because we're talking about upwards of 5 years of co-design, right? Once you're integrated at that level, you're essentially married to the foundry.
Exactly, and that's why they're so confident pushing production forward right now, while, well, even laying the groundwork for their next major technology leap out in 2028. They're playing a very long game of Monopoly here.
A monopoly that charges a massive, agonizingly expensive entry fee just to keep your seat. It's equal parts awe-inspiring and honestly slightly terrifying. But I suppose that's what happens when you're building the physical engine for the AI economy. Anyway, I think that's a brilliant place to wrap this up.
Always a pleasure. See you next time.
To catch these earnings teardowns as soon as they drop, go ahead and hit follow wherever you're listening. Just a quick reminder that this entire show is an AI experiment, synthetic voices and an AI written script included, which lets us condense today's 30-page TSMC transcript into your feed the very same day. Send over the next ticker you want us to cover at earningsunscripted@datamadness.ca or find the X link in our show notes.
Thanks for listening.